Well, Paul, welcome back to the podcast.
Rob, thanks for having me.
It's great to have you, Paul. I think you and I were last in this forum sort of mid-July, and I think that was a week or two after you reassumed the lead portfolio manager role for the global equity strategy. And back on that podcast, you laid out a bit of a near-term vision. And so I was hoping that we'd use this time today as a bit of a progress report. How have things gone since you and I last connected? What's changed? And I wonder, can we start with the team? With you and Dave back on the global equity strategy, what's the team dynamic looking like?
Team's been great. So the first thing Dave and I and Manar have been doing is just engaging across the entire team. And that means everything from spending time in models. We had a great session with a client, actually spent about an hour inside the model, stress testing it and looking at the Monte Carlo analysis. And this was a top holding that we subsequently increased our exposure to. From model time to conversations in Singapore and understanding all the good work that our teammates are doing on the AI complex, and just basic changes to structure to improve how we collaborate. One of the things we did, Rob, was we merged our weekly global equity meeting with our US meeting. And that has yielded great benefits. We're in step with each other, and there's been a lot more cross collaboration because of it.
Where did you start, Paul? I can imagine, a portfolio of around 50 stocks when you took it over. Do you just sort of start at the top to reacquaint yourself with the businesses, or how does that teamwork look like?
I'm pretty well acquainted with the businesses. I ran this for over a decade, so that so much wasn't the issue. Where we started, back to the people, we asked some really simple questions. We asked all of our portfolio managers and analysts, what are your top ideas? What do you think we should be doing with it? And what bubbled up to the surface was some great ideas that both fit our investment philosophy and ultimately were diversifying for the portfolio. One of the ones that came out from our international team was an increase in exposure to Taiwan semiconductors. This is still a security that trades at a pretty reasonable valuation, has a wonderful growth trajectory ahead of it, as you can imagine, and has already improved portfolio returns for clients. And that's not me and Dave as much as one of our other portfolio managers that gave us that suggestion. So that's where we started with.
One of the goals that you had when we spoke back in July was, and you mentioned it earlier, was just improving the diversification of the portfolio. A very simple point on that would just be the number of holdings. Last I looked, you were north of 70 in the portfolio. But can you dig a bit deeper with respect to just that concept of diversification and what's that look like with respect to rounding out the portfolio?
There's a few different layers to that. The first is really basic industry or gig sector diversification. So I think when we came in with the portfolio, we had a large overweight exposure to consumer staples when actually things were going pretty well across the economy and we didn't need to be there. Same thing, and a little too much exposure to consumer discretionary, where that segment is difficult as it is, because remember, just the nature of discretionary is the customer gets to choose whether or not they buy the product. So all else equal, and this is my investment bias, less discretionary business models. And so that drove some of the diversification. We increased the number of small positions in the portfolio. And some of this provides us optionality and landing pads as the market shifts. We have something in the portfolio, we're completely on top of it, and we can allocate and move capital very rapidly. And some of it is just to take advantage of small positions, which themselves might not seem that significant, but when you add up a number of positions related to a theme, it's a way to get liquid and maybe better risk-adjusted exposure. I'm thinking in particular the AI complex, where you can imagine all these pieces of infrastructure that go into the memory that's required or the power that's required in these data centers and racks, or the fabric that these chips are made of. there are some really great businesses in Asia, high market share, high returns that we've added to get exposure. And I think it's a lot smarter than increasing our exposure just through, call it headline names that you might be more familiar with. So for all those reasons, I think the diversification has improved the portfolio, Rob.
Another topic that we spoke about a few months ago was this notion of fundamental momentum within a business and how your bias was to be more positively aligned with good fundamental momentum in businesses and to reduce perhaps those where the momentum was moving in the wrong direction. How's that transpired with respect to the portfolio over the last little while?
It's been really good. There were some, I'll call them problem childs in the portfolio where, and it's not that you can't be in that security, but it's a matter of weights in the portfolio. Those were adjusted downward. And likewise, there's some companies where earnings momentum was really good and we increased the weights. And it makes all the difference in the world. And in particular, and most people won't see this. Obviously, this was a transition quarter, but on a day to day basis, what's happening is we're starting to get that down capture back. And that's just so important to our overall style of what we're doing, where if the market's dropping, we're tending now to drop less than the market. And a good chunk of that is not only the general investment philosophy and the business models that we're investing in, but that characteristic of we're not offside on the earnings momentum or the business momentum.
With a higher name count, and you mentioned this earlier, I wanted to just dive into this a bit deeper, that clients may notice a slightly longer tail in the portfolio. Can you explain just what that means, that expression of tail, and just go a bit deeper with respect to the benefits of having a larger number of securities in the portfolio, perhaps at below average position sizes?
Absolutely. And so just to explain the tail, let's talk about just for contrast, the top 10 securities in the portfolio that typically represent uh, you know, 35 to 40% of the portfolio. But then a number of the securities might be very small, anywhere from 5 basis points or 10 basis points, about a tenth of a percentage point, all the way up to 1 percentage point. Now, why would you have a tail? Sometimes securities are so important that you want to be very close to it. You want it covered. You want to be following it every day. And one of the reasons you do that is so that if Mr. Market opens up and gives you an opportunity to add to it, you are completely on top of it and can make that decision really instantaneously without trying to do extra work and bring up coverage on a security.
Can I interject though, Paul? I mean, we certainly have lots of inventory. In other words, companies or stocks that we don't own, but that we've done the work on. How is this different? Is there an emotional element to having something in the portfolio? Just curious on that side.
There's a couple things. You're mentioning there is a psychological element sometimes. There is more friction to putting a new security in a portfolio than adding incrementally. And so often you can move in a small way to put the security into the portfolio and really break the ice. And psychologically, that's pretty important because you want to stay as unbiased as possible to that emotion. So that certainly can be a big element to it. But also there can be just a more general friction in putting in security into the portfolio because there can be a higher bar, or it might be more contentious, or you're collecting more input from people, and sometimes that takes time. That's the offset of process. So this way we can get the best of both worlds in terms of having done that process and then being close to the security for that optionality.
Can I assume too, and maybe, by the way, maybe this is the wrong assumption, but would these companies in the tail, would they be more, call it, well, you mentioned the word contentious names, like areas of bigger disagreement within the team, areas of sort of wider dispersion that creates these smaller position sizes? Or like, is that the right way of thinking about them?
It can be. Sometimes it's risk management. It's just simply it's a riskier security. Sometimes it's more there's a risk that's more, could be a one or a zero. Sometimes it's just a matter of liquidity. But a key insight for people, I think, is when you start small, you can over time add to that particular security. And with compounding, it's amazing how a security that sits in your tail could grow into a large position and be a big weight in the portfolio. And as a firm, if I reflect back, one of the a case in point for us is the study of Constellation Software, which now is a whole household name across Canada. But there was a time, over a decade ago, where that was a very illiquid security. And you started small and you saw how the business model evolved and you saw how Mark Leonard developed the business and managed the people. You added to it as the business grew and as valuation made sense. And that grew into a very large company, a much more significant weight across a number of different portfolios. So I just want to emphasize that portfolio management is not just this static number today, it's an evolutionary process.
You mentioned the AI complex as being an area of focus for you. As you and Dave and Minar have really engaged the team and sought the wisdom of the crowds, as you spoke about earlier, what are other pockets of the market where you've found opportunity and that we've seen shifts in the portfolio?
My observation is that some of the best risk adjusted returns are out in Asia. And these infrastructure like parts of the value chain where there's a critical process, the companies have high market share, even if it makes for risk management purposes sense to only create a small position in the portfolio, we're really bundling that together to gain exposure to the theme. And we're not sure how this is going to evolve, who's ultimately going to win, what all the ramifications are going to be, but we're trying to get that risk adjusted exposure. As often is the case, with Asian securities that are just less efficient than American securities, I think we're finding some value there. AI, I mean, we could go down this rabbit hole too. I mean, that's a whole nother topic of where we are in this cycle. And the truth is, we haven't seen something like this since the internet boom of the early 2000s, late 1990s. So we're working really hard to not only add exposure that makes sense with that theme and fits our investment philosophy, but do so in a risk adjusted manner and really stay in the middle of the net, recognizing that things may evolve in a couple different paths. And we want this portfolio to be resilient to however the economy evolves, AI included.
Paul, how much change have we seen in the last 3 months? I think your estimate back in July was, about 15% of the portfolio you need to change to get it to a point where you were quite comfortable with the portfolio. Curious what that's looked like over the last 3 months, and are we there?
Yeah, I think the heavy lifting has been done. So I think we've executed pretty well on that. There has been approximately 19% turnover. And so that's a little bit higher, but pretty much on target from what we thought it would take. And we're feeling like it's in a good spot now. It's a lot more balanced, a lot more diversified. It's aligned with the platform. And so we're seeing how the portfolio is now trading in the market. And we're back to the future.
Question I've gotten a lot from clients has been, okay, you've made a change with respect to the portfolio managers on the strategy. What are the right metrics or guideposts that we should evaluate you on from here? How would you answer that question, Paul?
I think that you have to start to think about how the portfolio trades in context of the market regime we're in. If AI keeps on running, if gold is climbing to new heights every day and cryptocurrency, and that's a market regime where we're not going to beat the market. And we shouldn't want to beat that market because of the risk that it entails on that. One of the signposts, like I said, to the other side is watching, well, how does down capture look like? If the market heads down, is the portfolio heading down less than the market because of the resiliency of the companies and the fundamentals that we have in those businesses? So that is something that we should expect, and we're starting to see it. I think that a question for people to ask, and we'll talk about this more, is what's really important is the collaboration across the team. So just running our process, but continuing to get the best from all of our team members, whether they're sitting in Singapore or Toronto or Calgary or Seattle, wherever they are. And that's something that's maybe less visible, but crucially important, I think, as a milestone. So much of what we do in the decision making, Rob, and I know you and a lot of the viewers know this, but it's cultural. That's what we continue to work really hard on with this transition.
You mentioned culture, the decision-making environment. You mentioned earlier just some new meetings or meeting structures that are tweaks that we've made to better prioritize resources. What's next for you guys in terms of your priorities, whether it's with respect to the team or aspects of the market and the portfolios?
Well, one of the real fun projects that we have on the go is a complete review of the IT sector. And a couple of our team members are heading down and spending some time in California. We're pulling in some resources from Singapore and again, looking at infrastructure that's AI related and really a complete sweep, almost a zero budget or a zero based budgeting exercise of looking at this fresh eyes. How should we think about IT? And keep in mind, there's a lot of voting going on in the market right now. I mean, just think about what we do. We're looking for companies with competitive advantages or moats. And remember, there's a letter that Warren Buffett wrote about a moat around the castle, and that's what defends, the cash flow, so to speak. That's the analogy. That's where that term comes from. But with the development of AI, what's happening in the market is many companies are getting hit with the perception of risks that some sort of AI development is going to impact their business. And the votes that's going on in the market are making some securities cheaper. And there's also voting on the other side where it's making other securities more expensive. And so the truth is, we don't know exactly how that's going to pan out. But I think that there will be opportunities on, for example, software companies that perhaps are more fairly valued and will both survive and thrive, and they can be purchased because of this risk. And there's going to be lots of learnings where things that maybe the world's going to evolve and change, and we have to recognize those risks. So that's the purpose of the project. Our team is really excited about it, and it's another forum for collaboration across many different people and asset classes.
Paul, last thoughts for clients.
I think we've moved pretty rapidly to put the portfolio in a position that's what people can expect to be an all-weather portfolio. We're going to do relatively well in an up market. We've brought the down capture back if we hit a speed bump. But the key message is it's about resiliency of the portfolio. We don't know exactly how the economy is going to evolve, how AI is going to evolve. And we're really trying to stay in the middle of the net. Just stay in the middle of the net, cut down the angle, and play the plan in terms of our investment philosophy and process. So that's what I want people to take away.
Well, Paul, markets evolve. But in terms of that message of staying in the middle of the net, being two spots at once, certainly something I've heard from you over many years in my time at More. Thanks so much for coming on the podcast.
Thanks for having me, Rob. Look forward to the next time.